My name is favourable. Today I'll be taking you through the Growthpoint Properties investment idea. In terms of the executive summary, we have 5 main points that lead us into our investment thesis, with the first being that we have a 14% upside on an intrinsic value of 16 Rand. The valuation is a bit skewed to the bull side, but that's because of our stance and some of the macro and company-specific factors considered in the valuation. In terms of the sector as a whole, given the relationship it has with bond yields and bond prices, we feel that the sector is undervalued, and Growthpoint provides a soft entry into the sector. In terms of real estate assets that have been underperforming throughout the pandemic until recently, office performance has been struggling. However, this is more of an industry-wide concern as opposed to a company-specific one, but it was considered in the valuation, and certain drivers driving office were considered as well. In terms of the quality of the company, we see it as having a healthy balance sheet and a strong cash flow relative to peers. And then on a price to funds from operations multiple, it is the cheapest relative to itself as well as its peers since the pandemic. In terms of the investment thesis, we have 4 main points, with the first being that Growthpoint and the property sector are correlated with SA bond prices and the Rand. In terms of the second point, diversification provides risk mitigation and a more alignment with the SAPY. In terms of the risk mitigation part of the diversification, it moves away from a concentration risk in one real estate asset type and rather spreads the investment around different types of real estate assets. And then in terms of the alignment with the SAPY, given the sheer size of Growthpoint and its composition of assets, it is more inclined to move with the SAPY, which has the relationship between the SA bond prices. So movement in the SAPY, movement in Growthpoint, expected to go hand in hand and adds to the first point of the investment thesis. In terms of the third point, occupancy levels are expected to revert to pre-pandemic. And that's when considering the different segments, the first being retail, we see that in a reversion of footfalls in retail. We see that in the stabilization of industrial as well as Australia, which are big contributors to the revenue line item, as well as office. Again, office being the an asset that is struggling in performance. We see 2 drivers for assets. The first being load shedding pushing staff to return to office, and the second being a rebalancing of Growthpoint's South African portfolio. And what that means is that they're simply pivoting out of more riskier, underperforming assets and moving in towards more performing assets. That means moving out of Gauteng and a little bit more into the Western Cape, as well as KZN. The final point being a dividend payout ratio should slowly recover to the mid-80s level as distributable income per share and dividends per share grows closer to pre-pandemic levels as guided by management. And then in terms of our final remarks, we have a buy on Growthpoint because of the upside, as well as our views on a company-specific and macro level. And when considering the macro level, we see the real estate sector as undervalued, and Growthpoint provides an entry point for us there. And then in terms of the quality of the company, we see it as having a healthy balance sheet, strong cash flow generation. And then in terms of what could change our mind, the first point being runaway inflation that would push central banks to speed up hiking cycles instead of slowing them down, further pushing the cutting cycles further into the future. The second being yield levels remaining elevated as opposed to coming down as per expectation. And the final one being the recovery by the main contributing segments falling below expectation.
Thank you very much for joining us today.